I think we're witnessing the unwinding of one of the biggest bubbles in history. I think this tech bust is far worse than .com. I think Oracle can go bankrupt. OpenAI will go bankrupt. This has the potential to be one of the most spectacular busts in stock market history. But I remember this quote, and I dug it up especially for you, David. February of 2000. If it's not tech, it's Drek. When someone says something like that, it kind of tells you where you are in the cycle. The market lost its mind, and the market's now going to start to come to its senses.
Semiconductor stocks are selling off hard, and our next guest believes this may be the beginning of the end of the tech and AI trade. He's George Noble, managing partner of Noble Capital Advisors. He was on the show 2 months ago in May. Check out the link down below for his last interview, and he's made a number of correct calls regarding the tech sector that's playing out right now, and he's going to give us his take on why tech is falling apart and why the entire market is at risk right now. This is probably one of the most perilous times for an investor in the last couple of years, he said. This is the biggest unwinding in the history of bubbles. George Noble is going to give us his take on what's going to happen next and where to hide and where to invest. This video is sponsored by Kalshi. It's the largest prediction market in the United States. Unlike a sportsbook, you're trading peer-to-peer on real-world events, from economic data to political outcomes, and the price moves based on public opinion, not a house. Go to the link in the description down below or scan the QR code here to get started and use my code LIN, L-I-N, to get $10 when you trade $10. Right now, there's a trade for how high the NASDAQ 100 price will get this year. And the majority of traders are bullish, with 77% thinking that it's going to go above 31,000. Well, George disagrees with that take, and he's going to tell us why and how high he thinks the NASDAQ will go or how low it will go this year. But if you do agree with the markets, and if you do agree with the 77% chance, you can put $50 down. And if you do, that payout could be $81 if you turn out to be correct. Link down below or scan the QR code here to get started using my code LIN, L-I-N. George, welcome back to the show. Good to see you again.
Thank you. Appreciate you. Thank you.
Let's start with this great rotation out of the semiconductor space right now. I'm going to show my screen, and I'll get to SpaceX in just a minute. I know that's something you wanted to discuss. So financials have been doing well. I'll get to that. So if you take a look at the biggest semiconductor names in the world, AMD peaked in early July. Qualcomm peaked in early July. Okay, actually peaked in June. It started dipping sooner than the others. Nvidia peaked around May. Intel peaked in early July. Okay, I'll show you this chart here. And just recently, SK Hynix in the last couple of weeks dropped about 70%. And 1.2 million South Korean trading accounts got margin called. That's about 10% of all brokerage accounts in the entire country got margin called just in the last 2 weeks. This is a serious issue. And not just are they completely underwater, which may actually put some strain on the entire economy because 10% of all the accounts are margin called, but is it a leading indicator for what's to come for the entire tech sector, you think? If the semiconductors are being rotated out, and is that a precursor to what's to come for the rest of tech, or is that good for the rest of tech?
Thanks for having me back, David. Huge fan of the show. I watch it regularly. And thank you for citing some of my prior calls. My gold call didn't work out so great, but we'll talk about that too. So at any rate, I think we're witnessing the unwinding of one of the biggest bubbles in history. Semiconductors, other things related to the AI trade got completely overcooked. The way bubbles start, usually there's an idea that captures the imagination of investors. It starts out as a good idea, but then it gets carried to an excess, to an extreme. Whereas I think it was Warren Buffett once said, what the wise man does in the beginning, the fool does in the end. We've seen this movie before. South Sea Bubble, Dutch Tulip Bulb Mania. I wasn't around for that. But .com, I was around for that. Housing bust. The pattern is always the same. It's fear and greed. Names change, people change, but the pattern is the same. It's fear and greed. And so you look at where we are. Say, let's just focus on semiconductors for a second. All right, I don't claim to be the world's biggest expert on semiconductors, but you look at the valuations, you look at the positioning, you look at the massive capacity that's coming online. I know people are talking about the incredible growth that's going to occur. And you look about the unsustainable trajectory of spending by the hyperscalers. We're going to see earnings in the coming weeks from the hyperscalers. I think it's only a question of time before one of them announces a cutback in capital spending. And when that happens, the whole semiconductor food chain collapses, in my view. You mentioned Korea, South Korean market. Koreans like to do things with a little bit of gusto, shall we say. There was I don't know if it's called hilarious or sad article I read this morning referencing the same thing you were talking about. Headline says, "Give me my money back," screams one Korean individual. I want to go back to before I started investing in stocks. Give me my money back. You're determined to kill me, another said.
I saw that article.
Yeah. Right? I'm like, okay. Now here's the really, I don't want to get into jargon, right? Yeah. That's not the point. That's not the point. Because some of us tried to warn people, all right? But everyone gets so, that's the article. Everyone gets so drunk on, the fact that prices are going up. There's another article I saw yesterday. The guy was blaming the decline on deleveraging and chasing momentum on the downside. Wait a second. Did leveraging and FOMO have anything to do with the price on the upside? So, and the problem is everyone's in. They're all in. And the worst thing, and you and I were talking about this before the show started, I saw some data which suggested that since the peak on June 22nd in semiconductor stocks, if you look at the SOX, or the three leading semiconductor ETFs, $25 billion have gone into those ETFs. That's not what you want to see if you want to get bullish on these stocks. So prices have come down. The big deal, they're down 30, 40%. They went up like forever for the last few years. Prices are down, but positioning hasn't changed, in my view. And so I think you've got huge stale bull positions that are stuck and now coming to value. So positioning is wrong. The momentum is wrong. The valuation is wrong. Buying semiconductor stocks on 8 times revenues or book or whatever, history shows that it's not a good value proposition. The capacity increases are coming. It's just a question of when it's going to hit the bottom line. And if you allow me to just go on a little bit further, David, I'd like to just give an example that I've never given before, but I thought of this last week. If you think it's stupid, you can blame it on me. If you think it's genius, you can give me the credit for it. I liken what's going on in semiconductor stocks to shipping stocks. People are going to say, what? Shipping? Yeah, shipping stocks. Let me tell you why. Shipping is a very capital-intensive, asset-heavy industry. And there are long cycles up and down. Remember, asset-heavy, capital-intensive. Gee, semiconductors fall in that category? And what tends to happen, because supply is relatively inelastic in the short run, when demand increases, you get tremendous pricing. And so imagine you and I own a VLCC. We have David Lynn Tanker Company, right? And it's costing us $20,000 a day to operate the vessels. But now the day rate goes from $30,000 to $100,000. Costs are the same. All that accrues to our profit margin. So you could have David Lynn Tanker Company selling on, 12 times earnings. The next thing you know, it's 2 times earnings. Because everyone knows those earnings are unsustainable. It's a pinch point. It doesn't last. You would never, ever, ever capitalize a shipping stock's earnings. Never. The way you value shipping stocks is you look at it relative to asset value, relative to book value. You can try to mark calculate the real asset value by taking the book value and marking it to market for the current value of the ships. So anyone who values a shipping stock on a price earnings ratio, well, first of all, it doesn't happen in the shipping industry, and they're financially illiterate if they do. I would humbly submit for your consideration. That's exactly where we are with semiconductor stocks. It's a commodity business. It's only a question of time before the capacity announcements already have come. And people say, well, look at the demand. Yeah, well, what happens if hyperscalers stop spending? Maybe because there's no cash on cash return from what they're doing, which I think is going to happen. Oracle's going to go bust. Going to go bankrupt at this rate. That's a stock, by the way, we called out as a short last year. It's worked out very well for us. And people say, well, George, do you know more than Larry Ellison? No, I don't. But whenever you see the combination of hubris and debt, run, don't walk. And so the semiconductor stocks, yeah, they on a PE basis they may look okay, but the bubble is really in the E. When you have gross margins going from 25% to 75%, and long-term averages is 25, and what will happen is once supply catches up, and you trust me, if you're in the finance department of a semiconductor company, and you can make an obscene return on equity by opening a new plant, you'll do it. So these excess returns that the market's seeing right now, and they're trying to capitalize, they're going to be arbitraged away. Earnings will be good this year. They may be good next year, but that's really a one-off. And so I would short the semi. Look, they may bounce. They're very volatile. I'll land this plane.
Well,
I know most people don't short, but what I would say in terms of the indices, the simple thing folks can do, if you own SPY, get out of SPY and go into RSP, because as you know, David, tech is like 40-50% of SPY. It's a much lower weighting in RSP. If you run the switch chart, you'll see what I'm talking about. And a simple trade like that, just going from SPY to RSP, I think will add to your performance immeasurably.
Yeah, there's RSP and there's SPY. I want to show you Intel one more time, just to illustrate a point here. STC here. So if you take a look at what the stock is doing right now,
yes.
Okay, it's down about 33% from its top in late June. So in a matter of 1 month, it's down 33%. Why is it not giving me?
Dave, you know what the problem is? You got in the wrong currency. You went INTC.
Yes.
INTL is another INTC.
There we go.
That's the
Sorry, I got the
problem.
wrong ticker there.
Okay, there you go.
Last time this happened was, I was trying to find the last time this kind of pattern happened, when it went up this quickly and went down this quickly. That was the tech bubble. This is literally a replay of the tech bubble, except not to the same degree. It hasn't gone down 70%, but it's on the way there. If so, two questions, okay? One, right, is this a repeat of the tech bubble? And two, if it's not, wouldn't this be a great buying opportunity if you're expecting a huge rebound? Right?
History doesn't rhymes, it doesn't repeat itself. It's not always exactly the same.
Sure.
It's similar, but it's different. In particular, I think this tech bust is far worse than .com. Julian Guerin, who I think I've mentioned on this show before, a rather erudite strategist who I've known for many years with MacroStrategy partners in the UK, has made the calculation that the malinvestment is 17 times what we saw in the .com era. The thing about this boom is that it's much more asset intensive, and the sums of money involved are much greater relative to the economy as well. So that when this thing implodes, I think it's going to have a significant economic impact as well. So no, this is not a buying opportunity. Listen, can Intel bounce 20% next week and all the haters are going to be throwing tomatoes at me and say, hey, George, you were wrong? Yeah, that can happen. Check back with me at the end of the year and let's see how this played out.
Traders are still pretty optimistic on the NASDAQ overall. How high will the NASDAQ 100 price get this year is a trade on Kalshi. Right now, 31,800 or above, 61% chance. We're currently at 28,000. So people are still slightly bullish.
Yeah, and let me just jump in there, David.
Yeah.
I had a call the other day, a webinar. John Roque, one of my favorite chartists, who you should have on the show. I'll introduce you. He observed that, and he's a smart cookie. He says too many people are asking him, "Is it okay to buy? Is it okay to buy? Is it okay to buy?" You don't have people saying, "Where's the bottom? Get me out! Panic sell." He goes, "Too many people want to buy this group." In the same way, to be fair, and I didn't listen to John. He says one of the problems with the gold stocks, the silver stocks, which you and I are both partial to, is because they overachieved last year. They got over the skis, so they're going through this period of consolidation. I still like them very much, but John thinks it could take longer for the consolidation. Why? He goes, "There's too many people still looking to buy." But against that, and then when it bottoms, you want to see bottoms. You want to see people just giving up on stuff, right? However, against John's observation, I would point out the daily sentiment index on gold is at 0. So I think gold is in the process of making a bottom. And again, check back with me in 6 to 12 months. These are investments; they're not trades.
Yeah, let's talk about gold now. We'll come back to we'll finish off on the S&P, the tech sector, towards the end of the interview. But gold, you said you were wrong on gold last time you were on the show. Why were you wrong on gold?
And again, Dave, it's always obvious after the fact, isn't it? Okay. Well, The fact that you've had the dollar's been going up a little bit, a few percent, and you've had rising bond yields. I mean, if you didn't know anything else, if that's all you knew, I said, David, rates are going higher and bond yields are going up, you'd say, yeah, it's probably not good for gold. All right. So that's why I've been wrong. However, I think the strength in the dollar is going to be short lived. And furthermore, I really like Luke Groman's quote. I mean, we all kind of know conceptually that rising rates are all things being equal, are not good for gold because it's a non-income producing asset. But Luke had a great rejoinder. He goes, yeah, but rising rates in a country that can't afford rising rates are bullish for gold. In other words, how far can rates go up before the economy, before they have to start easing materially? So we washed out all the tourists. They got rinsed. If you've been in gold as long as you have or I have, David, this hasn't been a great year so far, but we're only in July and we've absolutely killed it the last couple of years. So I think before it's all over, gold is at 10,000 or whatever. So I remain the whole reflation complex generally, I'm still very positive on.
The notion that higher rates will be positive for gold is quite contrarian. If you take a look at what the big banks are doing, Bank of America cutting gold forecast because of the expectation that rates are going up, reduced forecast by 14% down to 4360 an ounce. We're currently at 4,000, so less than 10% bounce from here. Is their forecast. So not completely bearish, but slightly less bullish than they were before. Why would rising rates be positive for gold?
Right. Well, like I said, all things being equal, rising rates are a negative for gold. However, if you're in a situation where, we'll take the U.S. or, you're in a situation where you think the rise in rates it will be somewhat limited because rates can only go up so much because of the debt problem, or there'll be like yield curve control. So let's say yields start going up, and as Michael Howell, a good mutual friend, would point out, they're eventually going to engage a yield curve control, YCC, and suppress rates while inflation continues to drift up. I mean, real rates have been going up. That's negative for gold. But the question is to how long can this go on for before they have to ease? And I actually think that ties into the technology. The two are related at the hip, they're joined at the hip, actually, because as you know, David, pretty much all the growth in the economies come from technology, largely driven by the AI, the data center spending. If that goes off the rails, as I expect it will, you're going to see growth really come down. And with it, I think rates will come down, and that'll be great for the precious metals complex.
I've been hearing conflicting opinions on what the Fed actually would do this year. Here is the prediction market, Kaushi, again. 70% chance they'll raise rates before July 2027. Okay, that's next year. Before 2027, 55% chance. Some people have said that they don't agree with the markets. They don't agree with the consensus view, and there's no reason for the Fed to hike rates yet. What's your view?
It's interesting. Trying to predict interest rates is almost as useless as trying to pick the oil prices. Okay. I remember I did my senior thesis at Yale on interest rate predictions, and I back tested what the futures market was saying, what the predictions were, what came to pass. And the tracking error was just insane. David, as the saying goes on X, you're old enough to remember when. Go way back to December of 25, 7 months ago, when it was on everyone's bingo card. How many rate cuts are we going to get? I got more rate cuts than you do, right? Where'd those guys go? Now the story is, we're going to get rate hikes, okay? I think it's watch, rinse, repeat. So I don't put a lot of stock in these forecasts. And furthermore, your question about the Fed just follows the market. They follow the market. They don't, they certainly can't influence the long end. Well, they can in an indirect way by not issuing as much paper, which is what they're doing. They're trying to fund everything at the short end. But they generally don't control, unless they're doing Asian QE, they don't control the long end. On the short end, they follow the market. And David, look at this. I mean, since the war, by the way, I've lost track of how many ceasefires we've had, but now it's getting worse again. Since the war started, bond yields are up like 40 basis points. The 2 years up, I don't know how many basis points. I was reliably informed that rates were going to go down in time of war. It's usually what happens. They went up. And to me, that's very significant. That's a tell. That's a harbinger of things to come.
What's to come? Harbinger of what?
Well, that all these folks have been claiming yields going down, yields going down, yields going down. No. I've been bearish consistently on bonds for 2-3 years, and I'm not changing my tune. I think when you think about it this way, David, given the surging debt we have, the deficit's out of control, we know that. But then the new piece of it is and I think he had Jay Plosky on a while ago, his story of the CapEx boom. So demand for funds coming from the private sector. So demand for funds is surging while, foreigners aren't buying our paper anymore. And you look at the real yields, I mean, the 10-year 4.5% with inflation sticky over 3%, $2 trillion budget deficit, actually $2.5 trillion now. We take in 5, we spend 7.5. We have $40 billion to $40 trillion debt. We have $125 trillion off balance sheet liabilities. The rates are too low, in my opinion. Interest rates right now are not acting as a brake in the economy because you got fiscal dominance and capex dominance. The way rates are going to go down, if they go down, you're not rooting for that. In other words, the most likely way rates are going to go down, in fact, in my opinion, the only way rates are going to go down, and they may not go down because the budget is going to blow out, is if the economy goes into the tank. Economy goes into the tank, demand for funds gets mitigated, but then on the other hand, you got the budget deficit surge. So they're in this trap. I don't think the Fed has a lot of good options. The other day I was speaking with a smart fellow, and he said to me, he goes, I said, what would you tell Kevin Warsh right now if you were the Fed governor? He'd advise him to quit.
Yeah,
there are no good options. There are no good options.
So you say you won't turn negative on gold until you see responsible fiscal management, which probably won't be this year. So you're still long-term.
It's not going to be in our lifetime, David. I mean, look, the dollar's gone down 98% against gold over the last, 80, 100 years. It's not going to change. It's going to keep on going. And so when people look at their stock portfolio, we had this conversation before, it's like, yeah, you're looking at nominal dollars. Okay. I gave at a conference last year, it's a funny story. I showed people a chart of the bond market, the TLT. And the TLT went down for 4 consecutive years, actually going down again this year. It went down, it's going sideways, it can't rally. So I asked folks, what do you think of this chart? They're like, it doesn't look very good. It crashed, but it's not bouncing. Okay. Then I took the TLT and I divided it by Turkish lira. The Turkish lira is like one of the world's worst currencies. So if you own a dollar-denominated asset like a bond and you measure it in Turkish lira, it's going steadily up from the lower left to the upper right. And then finally, I took the TLT and I divided it by units of gold, by ounces of gold. Now that's going from the upper left to the lower right. And I asked everyone, so what do you think of these 3 charts? I go, well, the first one, is kind of mediocre. Second one looks great. I like that. It's going up. And the third one looks terrible. It's going down. I said, boys and girls, ladies and gentlemen, it's the same item. It's the same item. The only difference is the unit of account. American pesos, Turkish lira, or ounces of gold. And so I think, as is always the case, David, we're going to get a soft default. The U.S. government's not going to rag paying on its debts. We'll just print more money, and we're just going to try to inflate the debt away. And that's really why you need to own gold, to preserve your wealth in real terms. So I just think right now, there's just we're going to see money printing in store as far as the eye can see.
Okay. Let's talk about another trade idea here. This is on your own Substack, the Noble Update. The world is running out of places to get oil in a hurry. You commented that running out of oil in a hurry means short tech, long energy is the one thing to remember. Tell us about this.
Sure. So tech, we've beaten to a pulp. Energy, we were positive. We turned positive on energy into last year in December. Had nothing to do with the Straits of Hormuz. Straits of Hormuz wasn't even a thing at that point. It was just that, as you know, David, energy suffered from years of underinvestment while energy consumption continues to go up year after year after year. And, you're looking at a 5% plus depletion rate. So you need to keep spending more and more on CapEx just to sustain production. And CapEx in real terms in the energy patch has gone down by 70% in the last decade. So there's a need for more investment. And the way you get more investment is you've got to have higher prices. So that was the fundamental backdrop. Then the stocks are very cheap. I was using at the time, I said, look at Schlumberger against Microsoft. This is an example of energy versus technology. And that trade blew out by 100% Schlumberger's favor. Okay, so energy was doing really well up until February 28th. The war came. And from end of March on, energy went through a really rough patch. It's kind of counterintuitive. The price of oil went up, but then it came back down, but the energy stocks went down anyway. And a couple of weeks ago, with crude WTI down, I don't know, 70, sub 70, I was like, enough. There's a complete disconnect between the stocks and the oil price. And they said, watch, wouldn't it be something if you get a truce and the price of oil goes up, not down? It's exactly what happened. What we didn't know, none of us knew, one of the big imponderables was the fact that Chinese, I guess you start talking about this, the Chinese cutting back on their imports of oil to tune of about, I think, 4 or 5 million barrels a day. And that reduction in demand from the Chinese helped offset a lot of supply problems from elsewhere. On top of that, you had, the SPR being drained, in various places, inventories being depleted. So the world economy has been shielded from the reduction in oil coming out of the Gulf. However, the Chinese will only reduce their imports for so long. They're not going to issue a press release saying, hey, we're buying, just like they didn't issue a press release when they stopped buying. But you look at the price action in the last few days, there's good reason to suspect that they're at it. You combine the fact that inventories are way down, need to be depleted, SPRs need to be depleted. Along with, at the same time, you look at retail positioning. It's almost like all-time speculative max shorts. It's absolutely perfect. Like, what could possibly go wrong, David? You got the squeeze on the oil price, right? And you got the retail guys all short. So, look, I hope the situation gets sorted out in the Straits of Hormuz. It's terrible what's going on. My crystal ball is no clearer than anybody else's. If anyone thinks they really know what's going on, to paraphrase Alan Greenspan, you're not paying close enough attention. All right. There's a lot of misdirection going on and a lot of lying going on, a lot of manipulation going on. But I guess I had finished by saying, who knows what the oil price is going to do? I think it's flat to up. But you can look at what's priced in the stocks. If the stocks are very expensive, as tech stocks are, you'd say, well, it's big expectations. Could potentially lose a lot of money. But when expectations are really low and the stocks are cheap, okay, if it doesn't work, you're not going to lose much. So I very, very, very much like energy. I'll remind folks, energy is still only 3.5% of the S&P, roughly half of the market cap of one tech stock, Apple or Nvidia.
Let's take a look at this Reuters op-ed. For some of the reasons why oil didn't go up, we talked about this already. Chinese surprise oil imports went down. You just mentioned that. U.S. pumping more gas and oil. Strategic reserve, you talked about that being depleted. Trump bulls U.S. President Trump repeatedly wrong-footed oil markets by making statements about peace agreements and the resumption of flows through the Strait of Hormuz. Interestingly, just today on the 20th of July, oil prices turned low after Iran says U.S. talks could be pursued based on national interest. Every time a headline like this comes out, almost every time oil moves down. Okay, so that's number 3. Number 4, do we have a number 4? Yeah, Hormuz flows rebound.
Yeah.
And then, I mean, how many of these assumptions do you think? Okay, that's it. So how many of these assumptions turn around? Number 5,
Say with the last one. Hormuz, go back to that graph there. Hormuz traffic rebounds. Yeah, because you had 1,800 vessels trapped in the Gulf. Once they were able to leave, you get this glut of oil all over the place. But that's a non-recurring one-off. And more importantly, think about it. You got David Lynn Oil Tanker Company. So you got your vessel out. Fine, it didn't get bombed. David, are you going to send the vessel back in to get more cargo? I don't think so. So talk about it being a one-off. Yeah, no, I think most of them, if not all, these are one-offs. They've temporarily suppressed the price of oil. That picture is now rapidly changing.
Makes sense. Tell us about SpaceX and why you're still short SpaceX, or at least bearish on SpaceX, despite the stock falling significantly already since IPO.
So I want to give you credit. You pushed my buttons last time in a good way. And it's great, even if you only half believe what you were saying, to have a back and forth. It's like imagine we're at Oxford debate and you have to, okay, fine. So the valuation was never a question. We wrote this piece that got 1.5 million views on X. We were one of the first ones back in May. 11 times sales, blah, blah, blah. Everyone knows all that now. Okay, fine. But we didn't tell people to short the stock because we also acknowledged it was going to go into the indices. And so we're very clear on that. I have no position. But I said, wait to short. And sure enough, stock comes public 135. It went straight to, I think, opened at 170, 175, where it was, went to 225. And you had retail FOMO, and you had index inclusion. The stock, I'll give S&P credit. They did not change the rules for SpaceX, but FTSE Russell did. And that's an important index because there's 12 trillion of money indexed to FTSE Russell, 20 trillion indexed to the S&P. NASDAQ, higher name recognition, but not as important, only 600 billion. So once it got into the indices, those indices are forced to buy. They bought. Stock peaked at 225, waiting for the chart to roll over. We pulled the trigger to our subscribers, I think 145, 150 on the way down. We didn't call the top. But again, we're investors. We're not traders. We said the squeeze is over. The squeeze is over. Now, here's the important point. Forget about the valuation. Forget about the fact that SpaceX bonds can't find a bid to go down every day. Forget about the horrible fundamentals. Forget about the fact that SpaceX is an AI play with a rocket company attached to it. You look at the breakdown of the revenues, where the TAM is. They talk about $29 trillion TAM. 22 trillion is from AI. It really is an AI play with a rocket thing attached to it. The rocket thing is kind of irrelevant in the overall valuation. And then you've got the mobile communications thing, Starlink. Here's the problem. I don't know if this has been discussed in your show. Problem is the float. They only listed 5% of the shares. So I think of the 1.7 billion shares, only 85 million were listed, some number like that. Maybe a little bit more because of the green sugar. But what's happening now, shortly after their earnings, which is in the next week or two, 20% more of the shares are going to become unlocked. So the free float's going to go from 5% to 25%. In the ensuing months, it's going to increase by 7% every few weeks. So that eventually you're going to have 100% of the shares freely traded. I would argue that in no other universe, would a stock sell on 100 times sales, certainly with a market cap of $1.4 trillion, whatever it is right now. The only reason it is selling here, the only reason is because of this manipulation where they got included in the indices and there was forced buying because of the index inclusion. So grandma's 401k owns SpaceX. Okay, the average retiree who owns index fund owns SpaceX. This is not in the public interest. I don't care if nothing illegal was done. It's not the issue. It's wrong. If it's not legal, if it's not illegal, it should be illegal. Furthermore, the regulators and the thought leaders in the finance community sleep at the wheel. The head of the SEC should be drawn and quartered, Mr. Atkins. David Solomon, the head of Goldman Sachs, should be fried. So shouldn't Ted Pick, the head of Morgan Stanley. So shouldn't the head of FTSE Russell. So shouldn't the head of NASDAQ. This is irresponsible. People are going to get hurt. People are losing money. And now, wait for it. Just last week, SpaceX broke the issue price. We went through 135 like a hot knife through butter. Before we came on the show, I think I saw 125, all right? Everyone's a bag holder now. Anyone who bought in the public. Now, this comes the most important part. People who bought SpaceX in the private market and private placements over the prior few years, they instead of 135, they bought it at $10, $20, $50. And now, all of a sudden, it's worth 125, and everyone knows it's overvalued. David, if you bought SpaceX 5 years ago at 20 in a private trade, and now it's worth 125, and you look at it, you go, this is ridiculous. As soon as you're able to sell the shares, as soon as they become unlocked, you're going to hit the bid. And that's why a collapse in the SpaceX price is a feature, not a bug. It's set up to fail. So, I think SpaceX is worth about $30 a share. I've done a lot of work on this.
$30 a share.
$30 a share.
You're not buying into the long-term vision. Elon Musk responded to this tweet of another SpaceX skeptic. He said, "You don't seem to understand that SpaceX will be worth more than the rest of Earth if we accomplish our goals."
Yeah, and David, you don't seem to understand that if David Lynn wins the lottery, he'll become the richest guy in Canada. Yeah, I mean, pigs can fly. What else do you want to tell me, David?
So you're not okay. All right, but
I'm not a buyer. I'm not a buyer. Listen. I'll say it right here. Elon Musk is a disingenuous, lying grifter. I'll say that. He's been convicted. The penalty wasn't enforced on the whole 420 tweet takeover thing a number of years ago, okay? Elon Musk is not being held to account for his misstatements of fact. Elon Musk companies do not earn their cost of capital. David, I think I said this to you last time. Do you realize that in the whole history of Tesla, they've only made $38 billion cumulatively in the whole history of the company? but yet the thing's worth $1.5 trillion, and he's the richest guy in the world. Tell me the market's not broken. And by the way, the company's only made $38 billion in its whole history. That's despite tens of billions of dollars of tax incentives and emission credits. Elon Musk does not make profits. Elon Musk produces hopium. And
if the valuation is based on hopium and what investors think or believe in statements like that, what does that tell you about the market? What does that tell you about the investing public right now?
David, you must have talked to my grandfather. Okay. He always used to say, David, only ask questions you already know the answer to, okay? Okay, listen, we've seen this movie before, okay? Again, there's always a kernel of truth in the original idea, but then it gets carried to an excess, right? Yeah. And Tesla, honestly, 14 times sales for an auto company should be on 1 time sales. Tesla's worth maybe $50, $40, I don't know, 30, 40, 50. By the way, it's funny. It's kind of like the same target valuation for SpaceX. Meanwhile, SpaceX is worth, instead of 30, it's worth 135. Tesla, instead of 40, it's a 380 wherever it's. And by the way, we're short Tesla from 25% higher from last year. So I would short Tesla. I would short SpaceX. I'd short the semiconductor stocks and all the other stuff in the food chain. Just wait until the first hyperscaler cuts their CapEx budget. I think Oracle can go bankrupt.
You think Oracle could go bankrupt? That's a statement and a half.
Uh-huh.
Okay. So Oracle's the next Cisco. I mean, is that?
Yeah, kind of. I mean, look, Cisco avoided going bankrupt. I hope Oracle doesn't go bankrupt. But in terms of a gross misallocation of capital, the extraordinary amount of debt they've taken on, and the extent to which their fate's inextricably linked to OpenAI, which I think will go bankrupt. OpenAI will go bankrupt. They already put off their IPO till next year, if there ever is going to be an IPO. And so I think this has the potential to be one of the most spectacular busts in stock market history.
By the way, just on that, the most spectacular bust in stock market history is what happened with the SpaceX IPO, which is that it's down from its pre-IPO price in just a month. Is that a cautionary tale to future tech IPOs this year or next, or is that just unique to SpaceX?
No, it's a very good point you make, David. I mean, by the way, if all these IPOs were to come to pass, SpaceX, Anthropic, OpenAI, you read the same stuff I do. The amount of new issuance that we will be looking at would be extraordinary. One feature of the market in recent years, it's one of the many reasons the market's gone up, has been the supply-demand situation. Specifically, there's been very little issuance and a lot of buybacks. Well, if you look at the projected issuance, if all these things were to come public, not just in dollar terms, but in relationship to the market cap, the total market capitalization, it's an enormous number. So aside from fundamentals, aside from growth, aside from valuation, supply-demand balance for equities, because of this heavy new issue calendar, it was going to exact a huge negative impact on the market, in my opinion.
Do you think there's any sector within the tech space that is truly disruptive right now?
Oh, there will be winners for sure. But I think it's very hard to identify what they are. I think many of the stocks that people are chasing, they like to find choke points, things where there's a temporary supply-demand imbalance, and the company has a very high, strong market position, high profitability. But most of these things are commodities. And so I think it's too early to tell. I'm reminded, I read a story a few months ago, Warren Buffett, back in the 50s, one of his first big investments was into the textile industry. And the story back then was there was some new technology type of loom or some machine that was coming out that was going to reduce costs substantially for the textile companies. So this was going to improve profitability. The costs will go down and margins are going to improve. Well, guess what happened, David? First company got it, second company got it, third company got it, everybody got it. And as a result, again, it's competition, it's capitalism. The costs all came down, everybody's prices came down. Profitability for the textile industry did not improve. Wound up being one of the worst investments. He tells a story. So I think this whole AI thing, yeah, we're going to use AI. We are using it. You're using it. I'm using it. That's not the point. The point is, are the companies selling this stuff going to make any money? In the same way, and David, He used to work at Bank Credit Analyst. I had Peter Berezan on, who's presently the editor of BCA. I had him on my show a few weeks ago. And he made the point, it's really interesting. He's like, back in 99, 2000, people were predicting big things for the internet. And it actually turned out internet traffic grew at 43% compound, 43% compound for the next 25 years. So something like it's up 25 million percent. So if I said to you, David, or someone said to us, hey, David, you know what? You should buy these internet stocks. Internet traffic's going to go up 25 million percent in the next 25 years. Oh, that's pretty good. Well, guess what? Nortel, Lucent, Cisco, you lost 80, 90%. You got bankrupt. So the issue isn't whether or not the internet was going to become a big thing. The issue isn't whether or not AI is going to become a big thing. The issue is, are the companies going to make any money out of it? And is it a commodity? And I've not seen any credible path to profitability for these companies. And I think all just rushing into it and the market's just chasing it. And it's like, show me the money. So I remain abjectly again, they can bounce anytime. Check back 6 months, a year from now. I think this stuff is a lot lower.
Prior to starting your own firm, you were at Fidelity. What are some of the biggest lessons you've learned about categorizing investments or stocks or asset classes during your time there?
It's a good question. Well, first off, my mentor, Mr. Lynch, he's famously known for know what you own. Don't just chase momentum. Don't chase stories. Do the work. Know what you own. And I would humbly submit for your consideration, a lot of these folks don't know what they own. I'll tell you a funny story. In 1999, summer of 99, I was at a technology growth conference. Boston Marriott Hotel, Adams Harkness Hill Technology Conference. And I'm sitting there trying to learn. And the CEO of one of these things is it gets up there and he's going on and on about this technology, that technology. And I lean over to the institutional sales guy, a friend of mine who was there with me. And I said, Bill Crane, Bill, I don't understand the word this guy's talking about. He says, George, neither does anybody else in this room. It sounded good. A lot of buzzwords, a lot of word salad, but it was like, okay, at least I knew I didn't know what I was talking about. The other people in the room were fooling themselves. Peter, there's one great video, everyone should go find it on YouTube. Peter at the National Press Club makes fun of technology stocks. So one, know what you own. Keep it simple, stupid. Do not go for the long shot. It's also usually better to own an okay house in the best neighborhood than the best house in a crappy neighborhood. So in other words, what that means is groups and sectors tend to move together. All right. I learned that it's usually better to go with trend. Price, not the price is truth. I hate that saying, but price represents the sum of all information known to all market participants at any one point in time. And so if you're convinced that tech is going to go down and it's going up, you have to ask yourself, why are you the only one believing it should go down? Like, explain what it is that those guys believe that you don't believe, and how and when will what they believe cease to be true. So, investing in the stock market's not gambling. It's know what you own, all right? And what I really were afraid of in this market was so much retail involvement and FOMO. People are just chasing momentum. Valuation doesn't mean anything for them until it does. And now here's the problem too. Valuation didn't mean anything on the way up, i.e. prices could go well beyond what a fundamental fair assessment would be. So valuation was irrelevant on the way up. It's also going to be irrelevant on the way down, because the guys buying and selling this stuff aren't looking at momentum. They're just looking at trends and drawing crayons on pieces of paper. And so the market's become a real casino. I think I'm safe in saying that if Peter was around, if Peter was professionally managing money, he's managing his own money right now, but knowing Peter as I do, he would not own any of this stuff. He would be in energy stocks. He'd be in metal stocks. He'd be maybe in some of the consumer staples, while they're not sexy right now, but the ones that have good balance sheets, and there's a self-help story involved. Okay.
Final question to you.
Yeah.
Right. Let's take Peter Lynch, for example. If you take a look, if you use traditional valuation metrics, price to book, price to earnings, price to free cash flow, yes, you would have assessed that a lot of these stocks we talked about way overvalued, shouldn't touch them, but they were overvalued since a long time ago.
Correct.
One could argue if you use those metrics, you would have missed out on
Correct.
this bull run. How would you respond to that?
Yes. So again, markets rhyme; they don't repeat themselves.
Yeah.
All right. At the end of the day, prices follow earnings. Peter would famously give the example of Coca-Cola. It went up 30 times over a long period of time. It's because the earnings went up 30 times. Stocks prices follow earnings. Then it says, oh, Tesla, boomer, you missed it. Well, trust me, Tesla stock price has a date with its $1 in earnings per share. And the number is not going to be 375. It'll be 30 or 20. And so stock prices in the long run average follow earnings. So you're totally right. A more traditionally focused investor would have missed all this. However, I go back to, and I'll finish with one quote, which as Yogi Berra famously once said, you can observe a lot by watching. A lot of the best and most accomplished investors in 99-2000 were humiliated. They were forced out of the business. Julian Robertson basically had to close his doors. George Vanderheiden, who you never heard of, the second best manager at Fidelity, had his fund taken away. Chuck Clow was deposed as a chief strategist at Merrill Lynch. All right. Sometimes the market makes you look smarter than you are, and sometimes it makes you look dumber than they are. It depends where you are in the cycle. I would argue that some of the best investors have been made to look stupid, and some of the most inexperienced investors have been made to look like geniuses. And I'm going to finish with a quote. I prepared this especially for you, Dave, because I anticipated this question will come up. And sometimes you remember, like, where were you when this happened? Where were you when the Toronto Blue Jays, won the World Series or the Raptor? Okay. So where was I in February of 2000? Pulling my hair out because it was a month before tech was finally going to peak. I started shorting tech stocks in the fourth quarter of 99. I was early. But I remember this quote, and I dug it up especially for you, David. February of 2000. If it's not tech, it's dreck. I repeat, if it's not tech, it's dreck. This was uttered by Nancy Neiman, who was a portfolio manager of Warburg Pincus Asset Management Global Growth Fund, like the best performing fund in the world. If it's not tech, it's dreck. People only see, so when someone says something like that, it kind of tells you where you are in the cycle, all right? And you're seeing a lot of this similar arrogance now. You're seeing, as I said, run from hubris and debt. And I think we're in the beginnings. We're in the beginnings of the demise of this whole trade. It would not surprise me. SanDisk, are you kidding me? SanDisk, I think it went from like nothing to over 2,000. It's at 1,500. It's going back to 400. You had an IPO, this Japanese chip thing that came public last year, benefiting from the whole chip boom. It was an IPO. For a couple of months, not just recently. It was the biggest market cap in the Japanese stock market, bigger than Toyota. So going back to 1990, 2000, did George Vanderheiden become dumb? Did Julian Robertson become dumb? No, the market lost its mind. And that's what I think is going on right now. And the market's now going to start to come to its senses.
Excellent talk. George, thank you very much for that update. Where can we follow you? I mentioned your Substack. Where else?
Substack, X. Also, David, as you know, we're having a conference this Wednesday, another Stock Ideas conference. 15 of the smartest guys in the business, 14 of the smartest guys in the business plus me, each coming with one pick, $99, rapid fire session, money making, hard hitting, actionable, no bloviating fireside chats, replays available within 24 hours. The alpha generation in past conferences has been phenomenal. You mentioned Freshpet. Last time we had Astera Labs, it was up over 100%. So it's like a Stock Ideas dinner, except it's for the people. So don't miss it. This is like the fifth one we've done. They've been a lot of fun, and there's been a lot of alpha generated. So yeah, I'm on Substack, I'm on YouTube, Twitter. You can find me GNoble79.
Thank you very much, George. Please do follow George and follow his Substack as well as his conferences. Great lineup he's got every time, so check that out. Thank you, George. We'll speak again soon. Take care.
Pleasure.
Thanks for watching. Please do like and subscribe. Follow George in the link down below and use my code LIN, L-I-N, when you sign up to Kalshi. Link down below or scan the QR code here. Remember, new users who use my code LIN, L-I-N will get $10 when you trade $10.